Hey, good morning. Today's report is called Ask Your Hubby, Janet. Well, at any rate, Thanksgiving week turned out to be a wash with indices mostly flat. The big news actually was the aptly named Black Friday, which I'm happy to report is clearly in a coma and headed for a slow or maybe a fast and hopefully painful death. I've always hated that day, which got longer and longer, depriving mostly minimum wage workers of time with their families. I mean, really? The gig's up. It's estimated that sales dropped about 1.5%, which is not a big deal, but online sales increased by double digits. And I'm thinking, who wants to fight crowds on a full stomach the day after Thanksgiving when you could just buy the stuff online, stay home, have leftovers, and watch the football games? Really? Good riddance, Black Friday. And black it was in China on Friday, as stocks were down close to 6%, driving our own 10-year yield higher on a flight to safety. China's sell-off is blamed on a current investigation on short selling and margin financing in the largest brokerage houses in China, or so we are told. Today's Chinese market is actually closed in positive territory. I've never really liked China. Most people know that. I've never liked their economy or the country or anything that it had to offer to me. But anyway, that's beside the point. What's China to do? Because pressure on the currency forces the central bank to intervene to prop up the renminbi, their currency. That means that the central bank has to buy the local currency. Stay with me, I don't want to lose you. When you buy the currency, you're taking money out of the market and you drain domestic liquidity. And that causes panic outflows because companies and investors worry that the central bank won't be able to maintain this pace, and that could lead to a potential devaluation and, of course, the erosion in the value of the renminbi-denominated assets and investments. And devaluation could also adversely impact the cost of dollar-denominated debt. I cut my teeth in the FX markets in the early 80s. Yeah, that really ages me. When many U.S. corporations had taken on low interest rate Swiss franc loans, only to realize years later that repaying those loans was going to cost them an arm and a leg and then some, because the Swiss franc had taken it upon itself to sort of go up in value against the dollar a lot. Let me put it this way. The renminbi was allowed to devalue by over 4% back in August. And nobody really knows how much dollar-denominated debt exists in China. But by some estimates, it could be over $1 trillion. Yep. Remember the mortgage crisis and the floating rate debt that caused so many people to lose their shirts? Well, maybe then you'll understand that many companies and individuals in China did see the cost of their dollar-denominated loans in August go up by 1% in one fell swoop. And it may not be over. And no amount of Fed staying the course will help them. The sectors that could be in trouble in China are mostly IT, real estate, and of course the financial sector. And that, my friends, is what we need to worry about, dollar-denominated debt. And in my expert opinion, as an ex-famous foreign exchange person, I can tell you that no amount of intervention by the Central Bank of China will stop the renminbi from crapping out. Yeah, crapping out. Unless it is coordinated intervention by a group of central banks, including the Fed, the European Central Bank, the Bank of Japan, and a bunch of others. So, I don't know, the renminbi will continue to devalue in 2016. Period. Good luck. And talking about the Fed, I'm going to give the Quote of the Week award to Ralph Nader. Yeah, he's still around. In a letter to Yellen, he said that she should, quote, ask her Nobel Prize-winning husband, George Karloff, what to do about interest rates, unquote. I'll happily repay him for this blunder with one of his own quotes, quote, your best teacher is your last mistake, unquote, Ralph. Anyway, yeah, but since we're on the Fed subject, this week is going to be Fed Speak Week. Everybody and their mother in the Fed is going to be talking somewhere, in some place, at some time. But pay special attention to Janet herself, and especially Thursday's testimony at the Economic Committee in Congress. Tons of other releases this week may help Yellen make a decision later in the month about interest rates, unless she's already checked with George or with Ralph. Later on today, we'll see Purchasing Manager Index, and it's expected to show another slight decline. Tomorrow's auto sales should show a third month in a row of over 18 million units. Let's face it, folks, auto sales are strong, and yet there's this anti-Fed raising rate report that call for gloom and doom in the auto industry if the Fed raises rates by 1%. Why is everybody talking about 1%? It drives me nuts. There's not going to be a 1% hike. You know what? I'll put it in writing, and I will guarantee that this month the Fed will not raise rates by 1%. Period. Thank you. I know I'm right. Well, anyway, I'm sorry. In other news this week, although we have been ignoring the beige book, the Fed's beige book of late, maybe Wednesday's release could shed some light as to what the Fed is thinking, especially when it comes to wage pressures. Anyway, jobless claims on Thursday up slightly from the previous week, and maybe the most important number of the week again is Friday's release of non-farm payrolls, which are expected around 200,000, with the unemployment rate staying at around the very dangerous, in my mind, 5%. If you want to know why, just look back on previous reports. Also on Thursday, the ECB, the European Central Bank, meets to determine monetary policy going forward. But I think its hands are tied, literally. I mean, what's the European Central Bank to do? Lower the already negative interest rate further to maybe minus 0.3%? Expand the QE program? I don't know. I'm just looking at the euro at close to parity with the dollar, and I think it's going to drop below anytime soon, causing, some waves in the market. Anyway, just to close, Apple may be getting a Christmas and beyond boost because it appears that most of the US wireless carriers are going to offer great deals, are already offering great deals, but only to iPhone users. I've always liked Apple, much to your dismay. As a matter of fact, Apple was also the only light in the Black Friday market because I think, it was offering sort of, Apple gift cards if you bought an iPad or an iWatch. It's all a question mark. But you know what? One of my young advisors says that the companies of the future will provide, in his words, a great customer experience. And all I can say about Apple is that every time I go to the Apple store, I walk out with one of their products and a big, big smile on my face. That's the quote of the day, maybe, the big smile on my face. Anyway, this is Abroad with a View. Thanks for tuning in.